Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, there's a lot of stuff happening in the world right now, but one theme that has been just kind of like on a tear for more than a year or 2 years even is metals. We're going to have a gentleman join us, John Ciampaglia, who's the CEO of Sprott Asset Management. Eric, what's interesting about metals and Sprott's approach in ETF investing?
Let me give you a stat, Joel. About 2 weeks ago, the silver ETF, SLV, traded more in a week than any stock on planet Earth. More than NVIDIA, more than Tesla. A year ago, this ETF was ranked 168th. This is crazy. What happened with silver and gold, silver in particular, felt like GameStop. It felt like, what in the hell's going on? How does something that's mid-size take over in terms of volume? So silver had this just parabolic move up. Gold has been going up for a year and a half. But between the two of them, I think they combined for, I want to say something like 60, 70 billion in volume. These are ridiculous numbers. It's going to die down. It has died down a little bit. There's been a sell-off. But for the most part, these two metals really just went wild, particularly over the past couple months. And some people are calling it part of the debasement trade. It feels a little like FOMO to me. General investors have for a while now been buying equities like normal, but they've been buying gold. So gold has been a story for about a year and a half, but silver came out of nowhere and just went absolutely wild. And that's just caught everybody by surprise a little bit. But the ETFs, again, those volume numbers were absolutely ridiculous. And then there's some other things to unpack there, but I think it's just one of those things where you never know, Joel. Just when, things are like kind of going one direction, something comes from the side door and just goes wild, and silver was that thing. And where do we go from here? Both of these metals are like really at extreme positions. So what happens now?
Also worth mentioning, John's been on the podcast once before, a couple years ago when we did a uranium episode. So if you want to hear more, you can listen back to that one. This time on Trillions, Metal Mania. John, welcome back to Trillions.
Thanks for having me back.
Okay, so we mentioned this precious metals just having this incredible run. There's also like no shortage of ETFs that are offering exposure. So I'm curious, what does Sprott do differently, and why does that matter right now?
Well, Sprott has a long history in metals and mining. It's kind of our DNA, it's our culture, it's all we do. So we know it really well. And we do everything from investing in physical commodities, and that covers gold, silver, palladium, platinum, copper, and uranium, all in physical form. And we do most of the related equity-oriented categories. And we also do active management as well as some private investments. So we do everything in the capital structure, both physical commodities, passive equities, and active equities in metals and mining. So, we saw a lot of these trends starting to form 3, 4, 5 years ago, and we built a large suite of ETFs, not just in the United States, but we also have funds in Europe and Canada. And they're really designed to give investors opportunities to play a lot of these thematics, which we think are still in the early stages of their development.
So Eric mentioned the debasement trade, and I'm curious, that really became a theme, especially last year. It seems like it's really gone mainstream. When did that thesis first resonate with you, and what's changed even since then?
Well, at Sprott, I can tell you the debasement trade, that term we've been using since the great financial crisis. And it's only been in the last year or so, it's kind of entered the mainstream lexicon. And for your audience, I think we should define what it means, because it's not a typical term we use in everyday language. But debasement is a term to describe a situation where very excessive levels of debt, very high levels of inflation, are basically, eroding your real after inflation returns, whether you're investing in treasuries or currencies. And it's also a part of currency devaluation. Currency devaluation is very common when countries are in trade wars, which we're in right now. And all of these things kind of point investors to say, maybe I need to hedge myself against those risks. How do I do that? Well, precious metals for not 1 or 2 years, but for the last 5,000 years have been an alternative form of storing your wealth. And this is one of the reasons why gold and silver and platinum have all been really well bid over the last couple of years, because investors are rotating from, let's call it paper assets, whether those are treasuries or stocks in some cases, to more real things that historically have performed well in these periods of debasement.
Let's talk about this. So right now, I mean, inflation isn't that bad. The debasement isn't that bad. I mean, it's not like we just had a bunch of QE. It feels a little more like FOMO as well. It just seems like gold started going up because people were buying it for that reason. But then I think as it goes up, it gets more FOMO money. It just seems like more of a craze than it does seem like a general allocation to it for this long-term inflation hedge. What's your take on that?
We would describe it as a pivot. And the pivot is really twofold. It's one, I'm going to bring this more on a local basis. It's about running the economy very hot in the United States. That means allowing inflation to be higher than historic targets of 2%. That means running very high fiscal deficits, which is what's happening. It is also around very accommodative monetary policy, which obviously the Trump administration is trying to engineer with new Fed chairman. So if you're running the economy hotter from a fiscal and monetary perspective, I think that introduces a different dynamic. But take a step back and look at the big picture globally. This really started 4 years ago when Russia invaded the Ukraine. And so what does this have to do with gold? Well, $600 billion of Russian assets were frozen with a few keystrokes on the computer. And this was a real eye-opener for a lot of emerging markets and countries that aren't so friendly with the United States and other Western countries, that their assets could be seized or frozen very easily. And this is what really kickstarted and accelerated a shift. We call it de-dollarization, basically where central banks around the world and governments were basically selling treasuries or reducing their dollar holdings. And what were they doing with the money? They were basically recycling it into gold. The Chinese central bank was really the primary proponent of this strategy. We know they have hundreds of billions of dollars of treasuries that they are selling into the market and recycling into hard assets. It's not just gold, it's infrastructure, it's energy, etc. But there are a lot of central banks doing this. India, Poland, Singapore. They are moving away from dollars and treasuries as part of their foreign exchange reserves, and they're recycling the money into physical gold. And you're starting to see institutional investors mimic this behavior, which is why last year we saw very good flows into gold-based exchange-listed offerings, including the Sprott Physical Gold Trust. And this trend, I think, is starting to trickle down into more of the advisor channel and down to individual investors. They're kind of mimicking the behavior of these central banks. And so you might say, well, is this a short-term trend? Or is this part of a longer-term kind of fracture of the global world order? And right now it feels like the latter to us, which is why you have such a constant bid under the price of gold, why it's been so resilient. And obviously in the last few weeks, it's hit an all-time high.
So, God, there was a lot there. I want to ask about, you went from the institutional kind of to the retail. So let's pivot, if we may, from the institutional into the retail. And I'm curious, like, what role should metals play in a retail investor's portfolio now? I mean, there was this sort of like old way, and if you're describing sort of a new world, like what is the way that asset managers or financial advisors are starting to talk to one another about this?
Yeah, I mean, historically, gold has always played a safe haven role in a portfolio. It's always done very well, particularly in financial dislocations or calamities. And the other assets that always historically did well are things like U.S. Treasuries and the U.S. dollar. But last year, the U.S. dollar went down 10% against a basket of currencies. So that didn't really provide the shock absorber against things going on with trade wars and tariffs and the like. So what we see is some rotation of assets away from traditional treasuries to gold. And we think it's displaying a more effective hedge against some of the risks, whether it's currency, credit, equity risk. And we've always told our investors, and this is going back decades, that gold should always be kind of the ballast in your portfolio. You should always have some weight to it, depending on what you're trying to hedge against. But it obviously goes up around 8 to 10% over long periods of time. And then it obviously can perform well against other asset classes in a dislocation. But we've always said to people, you should have somewhere between 5 to 10% of your portfolio in physical gold, help you stay invested in other asset classes that historically have been more volatile.
Gold, but maybe not silver, right? So what's driving the interest in silver? Is it just price momentum, or is there something else going on?
Yeah, I mean, silver obviously and gold are very tied together, but there are some key differences between the two. Silver is what we call a hybrid metal. That means it has monetary elements to it and it has industrial elements to it. And I think it's important to take a step back and look at the price history of silver. I mean, silver was $50 an ounce in 2011. It meandered around for over 10 years. And in the last, I guess, 3 or 4 months, it was like a coiled spring. It had a huge catch up trade because gold was rallying first. But there's also kind of a geopolitical angle to silver as well, because silver is a very important metal for anything that conducts electricity. So think about defense industries, EVs, things where you need very high levels of electrical conductivity. Silver is your go-to metal. China has recently put export restrictions on silver, so there's some challenges there. The other element that's got silver kind of really going is substitution effects. So what does that mean? Well, what it means is if you're an investor in a place like India or another emerging market where you don't trust your currency because of hyperinflation or whatever, gold has become very expensive for those people. And so what we see is that as the price of gold becomes unaffordable for some groups in the world, they switch to silver. So a really good example would be India, huge owners of physical gold. When the price of gold kind of broke 5,000, we saw 85 million ounces of silver in just a 2-month period get imported into India. So they're basically hoarding silver. Now, as Eric touched at the beginning, was there a bit of a FOMO, memification going on with silver in the last couple of weeks? Yeah, absolutely. There was a absolute wild trading. Looking at some of the ETFs, we were watching the options trading on some of the ETFs. It got very excessive, and we've had kind of a correction here, which I think is quite healthy. But we're holding at $80. So, we were $50 an ounce in November, and we obviously broke through 100 and corrected back down to 80. But there's also a shortage of silver. We've had a supply deficit for 5 years. And that is obviously starting to catch up to the marketplace.
So SLV alone traded 146 billion in the last week of January, and that's an enormous number. And even leading up to that, we're talking like 8-10 times its average. Now, all that volume, all that return, and yet no flows. This was interesting to me. I want to get your take on this. So Joel, normally, like when gold started to go up, the flows came in. Like people were like, "Oh, cool." Silver, no flows. In fact, outflows. And I heard a theory, and it feels right, but I want to get your take on it, that silver, for a minute there, and I'm not sure if it still exists, was so hot in demand physically, especially in Asia and China. One guy tried to smuggle silver in through Hong Kong, got busted, and they put the picture of all the silver on. He was trying to snuggle it in these Danish cookie boxes. Anyway, I wouldn't mess with the Chinese government, but that's just me. Anyway, he's trying to get this in, and the thesis I heard was that the traders out there were using SLV for its silver stash. They were actually handing in shares of SLV to get physical silver back and then sell it and arbitrage it in the open market, especially in Asia. So it was almost like the ETF was getting rated for its valuable thing that it held, and that's why there could be outflows that overwhelm the inflows from the FOMO people. Thoughts?
Yeah, I mean, I think you have to look at it fund by fund. So Sprott has a physical silver trust that's actually been in net inflow. So we've been accumulating new dollars into the fund and buying silver with it. SLV is more of a trading instrument versus a buy and hold. And obviously, I think the options market for that is more the tail wagging the dog on that thing, just the way it trades. But yes, you're right. There are some arbitrage opportunities by location. So for example, there's too much metal sitting in North America right now versus places like London, India, or China, the other big kind of metal markets. And we know that because there's a price differential as to what the price of silver trades for in Shanghai versus New York. And there is a big spread. And traders are very opportunistic. If that spread provides an arbitrage opportunity, they will physically move the silver, put it on a ship, sail it around the world, and deliver it in vaults into whatever market. We haven't quite seen that yet because there's not enough arbitrage there. There is some VAT taxes in China that makes that arbitrage wider than you would think. But we see that all the time when markets dislocate. I think the great example right now is copper. We obviously saw the price of copper at one point trading over 10% over the price of copper in London. And traders were basically loading up ships and rushing it to the United States. So these physical movements of metal actually happen. We do it at Sprott all the time. We have to buy metal and move it around the world. But yeah, there's definitely, I think, the volatility has been exacerbated by some of the inventory mismatches right now going on.
Who do you call when you have to move metal like that?
Yeah, so we obviously work with different banks and shippers. And believe it or not, silver, I just give you a quick background on silver. So how do you move around these 1,000 ounce bars? Well, we put 600 of them on a semi-flatbed tractor trailer, which is a reinforced trailer. And we move 600 bars at a time. And sometimes it'll take us 6 months to move large quantities around to our vaults, but we do it. It's a lot of work, but we have a whole team of logistics people that organize this. And gold is a little different. It's obviously in armored cars because of the volume to value, but silver is so bulky, you need to put it on flatbed trailers.
Interesting about all this, like moving this merchandise around and ships. And I just finished a book project on Bitcoin, and one of the chapters is called The Store of Value Smackdown. And it's basically gold versus Bitcoin. One of the big arguments that the Bitcoiners have is, hey, if you want to move Bitcoin, you just like basically click a button. You can move it anywhere in the world. You don't have to get it through a border. There's nobody who's going to confiscate it. You don't have to call like a big ship up. You don't have to insure it. It's just easy. So it's like better version of gold. And obviously it has made that case pretty well. Even $70,000 after this huge pullback, that's still a lot of money per Bitcoin. And it's been around 17 years. Obviously, gold has really crushed in the short term. And Bitcoin crushed, maybe we'll call it 2023 and 2024. It was up 450%. Gold up way less. So they go back and forth. But what's your take on Bitcoin? Could it be used as the same store of value in, as they say, a digital gold? And is it even better because you don't have to worry about calling up a ship?
Yeah, it's a good question. We obviously get that all the time. I'm going to use your 17-year term and say that gold's been a store of value for 5,000 plus years. So we have a long history as humans in terms of our value and accumulation of gold. So it stood the test of time over millennia. 17 years sounds like a long time, but it's still in its infancy in terms of a new asset class. So, but yes, they have pros and cons. They're very different. It's not a digital gold. We don't like to think of it that way. It's a very different asset class. Obviously, if it was digital gold, there wouldn't be a 40% difference in performance just over the last few months. So they have very different audiences. They have some similarities. Yes, you can zip it around digitally, but there's obviously trade-offs with security. Whereas trying to steal gold is pretty challenging, given how heavy it is and how highly secure it is. So they can complement each other, but we don't like to think of them as substitutes at Sprott.
Hold on, Joel. I have a trivia question for you.
Ooh.
How old is gold?
I mean, like from the beginning?
Yes. Here's how old it is. It was mentioned in the Old Testament 350 times. That's old, man. If you're like getting shout outs in the Old Testament, I mean, that is really old. And that's why gold, I do think it should get respected more from the Bitcoiners. It's like you're 17 years old. This thing is like, has been through it. And every human generation has come along and say gold is valuable. So that is definitely worth something. I think they both can exist. But,
John, actually, I'm curious, do you think that the kind of the rise and popularity of Bitcoin, has that actually sparked an interest and expanded the interest in more hard assets that are physically backed?
Look, I think there's similarities in terms of what people are trying to do with each asset class, right? People are trying to diversify at the fundamental base from fiat currencies, which is basically paper money, which can be printed at free will and debased. There's that term again, over time from excessive money printing, inflation, excessive debt levels, et cetera. So there are some commonalities in terms of what people are trying to avoid. So those are the commonalities between the two. Obviously, one is a lot more volatile than the other. We don't see central banks accumulating Bitcoin yet. Maybe there are one or two that I'm not aware of, but we obviously have lots of central banks that have stored it as part of their foreign exchange reserves as a liquid tangible asset they can easily exchange for whatever it wants to when it wants to. So we haven't quite got central banks buying Bitcoin, maybe El Salvador, but time will tell to see how they play out.
One more question on this, because one of the other things that we bring up between Bitcoiners is, well, okay, gold is definitely scarce, because one of the big reasons to buy Bitcoin is there's only going to be 21 million and 20 million are already done. So you're almost at the capacity and it's locked in. That's hard coded. Now, gold, 3% is dug up from the ground a year, right? So there's a little bit of inflation. And then now they're talking about digging up the ocean floor, or even beyond that, mining asteroids. Joel, there's an asteroid called 16 Psyche. And did you know it has 700 quintillion
I did not know
of
that.
gold on it? That's enough for $90 billion per person on Earth. I don't know. That could really decrease the price of gold, no?
I think that's a pretty far-fetched.
Well, a theory, but it also, I will pivot into a question about miners. There's the physical and the physical back stuff.
Whoa. Hold on. I want to get to miners, but...
Well, he would have exposure via miners. Right?
Oh, yeah. Why don't they send the gold miners into the ocean
space.
or to space?
Well, how about, when was the last time somebody landed on the moon, let alone an asteroid? So I'm not holding my breath on that one. But you do raise another question, which is obviously being fiercely debated right now, which is basically mining on the ocean floor. There are these polymetallic nodules that sit way down in the bottom of the ocean, and there's a lot of debate going on right now across government agencies and countries around whether that is fair game, or is that basically something we should not attempt to do. And it's still not clear cut. But yeah, there's minerals all over the place, whether they're at surface, below surface, or at the bottom of the ocean. So that I think we don't have enough clarity on. But finding these minerals is not easy to do. It takes a long time to find a large-scale deposit that is economically viable, permitting, building mines, etc. There's a long lead time with commodities, and I think that's one of the interesting aspects of it. You might say, okay, all of these commodity prices have spiked, so we're going to have a huge supply response, right? The answer is no, because it takes so long to find these deposits, bring them to market. And yes, the incentives are very high right now, but it will take several years for new deposits to come into production, which naturally, I think, keeps these bull markets running much longer than normal business cycles.
Okay, related to that, we hear a lot about rare earths. The Trump administration obviously views this as a strategic competition with China. Obviously, there's nothing that looks like a rare earth ETF maybe ever, or yet at least. But what would it actually take, like not only for markets, but supply chains and regulation? What would a rare earth vehicle look like?
Yeah, we're investing at rare earths at Sprott, both passively and active. We have a fund called the Sprott Critical Materials ETF, and that does have exposure to rare earths. And maybe we should take a step back and say, what the heck are rare earths? Well, it's a group of minerals. Most of them I can't even pronounce, so they're so obscure. But they're very strategically important because they're used in very small quantities for very important technologies, defense industries, other technologies. Permanent magnets are used in electric vehicles, things like that. Now, so yes, they're rare. They're usually found in very small traces in other deposits, so they come as a byproduct. They sometimes are produced from smelting other materials. Okay, why does all that matter? Well, why it matters is that China controls between 80 and 100% of the processing of these rare earths. So it's not so much that they control the mining, but it's the processing that they have a stranglehold on. And we know that this is being weaponized. So for example, in the last few years, China gets into a spat with Japan. China says to Japan, we're not selling you any more rare earths. And this has not gone lost by many administrations around the world, saying, look, if we get cut off from these supply chains by China, our industries could be crippled. And this is why the Trump administration, and even prior, the Biden administration, has been taking steps to basically build, the jargon is resilient supply chains, which is code for diversify away from China. And so what's happening is a lot of energy policy and national security driven policy is driving the incentives to produce rare earths in the United States and other Western countries, to build processing facilities, because it's not just the minerals, you need the processing, which is very complex, to ensure that we have adequate supply. Now, just in the last week, the Trump administration's announced something called Project Vault. And Project Vault is $12 billion of funding to stockpile critical materials like rare earths. So this is basically we're going back to the Cold War, where governments basically stockpiled a lot of different minerals to ensure it was not disrupted. And, the genesis of all this is obviously in the 1970s when OPEC squeezed the oil price. It was really the wake-up call for governments saying, you know what, we're vulnerable here. If somebody shuts off our oil or rare earths, we could be really screwed here. So government is basically taking a very holistic approach to incentivize mining of rare earths and other minerals in the United States. They're talking about public-private partnerships. So that's things like loans to get these projects off the ground. The Trump administration has even gone as far as taking equity stakes in some of these mining companies, rare earths, lithium, et cetera. And they're taking in exchange for the equity offtake agreements. So offtake is basically a promise to deliver me future production. They're even contemplating in some cases price floors, which says we will guarantee a price of X for all that future delivery. That price of X may be above the current spot price. So you're basically putting a floor under the price so that it incentivizes and allows the project to get to completion. And one of the big complaints about China is overcapacity. And they basically flood the market with heavily subsidized production, which destroys the price and doesn't allow mines around the world from ever getting off the ground. In the last couple of years, we've heard here's a cobalt mine in Idaho shut because the price collapsed, because China controls the cobalt supply out of the Congo. So this is the chess game that's playing right now geopolitically around trying to wrestle control away from China of these critical supply chains. It's happening right now in rare earths. It's happening in things like copper. These are all metals that are very strategically important to the West.
How's that chess match going from your vantage so far?
Well, China has the benefit of playing a long game. And we seem in the West to go administration by administration. In terms of new administration comes in and they flip-flop and unwind everything that the prior one did. So we don't have the benefit of having a government that can play out the next 10, 20, 30 years. But I think it's basically awoken the giant, just like in the mid-1970s when the Strategic Oil Reserve and the International Energy Agency was formed. So it's not a fight over oil like it was in the 1970s, it's a fight over metals. This is a very different, I think, geopolitical struggle right now. And metals are at the forefront of it. And the reason is because metals are a very vulnerable supply chain, and metals are so ubiquitous in everything we do in our lives. Just about every industry, technology, defense, AI, all these things are very mineral intensive. So why are people fighting? It's not about rocks. It's about controlling chips and missiles. It's about controlling AI, data centers. All of these things are the new front line. And governments around the world are really responding to this challenge.
We're going to wrap up here, but I wanted to pivot to uranium since you are the issuer of URNM. Joel, uranium miners are up 22% this year, and I can't not do it. How much are they up since yours truly pitched this ETF in the best new ETF launch competition in early 2020 at Inside ETFs and came in third place, even though I should have won?
Go ahead, tell us.
550%. I remember standing up there. I was in front of a whole room, and I said, look at this back test. It started way up, upper left, down to the bottom right. And I said, I trust a crappy back test. This thing has been beaten up for 10 years. So it had room to run. And then I said to everybody, look, everybody here wants to be like Mr. Environmental, but how'd you get here? You didn't walk. If we want to go from A to Z in terms of like helping the environment, you just can't do wind and solar. It's just not enough. That was my pitch. I should have won. You know what it was, Joel? I was ahead of
John wasn't in the audience.
I know.
What's up?
And also, they had employees from the conference in the competition, which is kind of suspect, I got to say.
I don't know if you're bitter still. I can't tell.
Anyway, I was too ahead of my time. I think if I had pitched this 3 years later, I would have won. But I was super early. Anyway, you obviously were all over this. How big is this going to be? We actually reinvented this theme last year, Joel. We said this is a backdoor way to play the AI revolution because all these big Mag 7 companies seem to be either renting or building nuclear facilities or buying to, and they're using uranium, obviously, to fund the AI huge energy suck. What is the bull case here? Is it just the AI or what else is going on?
Yeah, well, I think you've been winning continuously for 5 years with your call. So congratulations. It's been an incredible run for uranium. And you're right, it basically was left for dead. It had a horrific 10-year bear market that basically wiped out most of the industry. And in the last 5 years, the industry has come back to life. It's really being driven by a number of really big pivots. One is around decarbonization. Governments are focused on lower carbon forms of energy. But more recently, obviously, energy security, because uranium produces just abundant amount of energy and affordable energy. And you're right, it is base load power, which means it runs 24/7, 365, unlike wind and solar that run 25 to 35% of the time. You obviously cannot run very energy hungry data centers on intermittent or variable energy. So this is part of this big shift going on around energy security and national security. Just a quick factoid, about 19% of the electricity in the United States today is generated from nuclear. So it's a huge part of the mix. It was forgotten, and it's now going through a new renaissance where governments are starting to take, nuclear out of the penalty box and actually provide incentives. The Trump administration has been very pro-nuclear. Lots of executive orders, lots of funding available to build new reactors. So it's coming. But the real story is China. China is building like 6 to 8 new reactors a year. And so if you look at the West pivoting back on top of places like India and China building tons of new nuclear capacity to increase energy production, you're looking at a uranium sector that between now and 2040 is forecast to double. So again, the cure for low prices is low prices. And right now, the uranium price has gone from the $20 per pound up to the mid-80s. So it's doing its thing. The supply response has still been kind of lukewarm because the industry was so shut in for such a long time. And so capital is finally coming back into the sector. This legacy stigma around the technology is largely gone. And we've seen tremendous success in our suite of uranium ETFs. We have the largest physical uranium fund in the world, which is about $7 billion. And so it's been a huge win for our clients the last few years investing in the sector.
Yeah, real quick on that. This physical uranium ETF, Joel, you guys get inflows. You have to go buy yellow cake, I guess, and store it. How does that work? And you ever been there? I mean, it seems like unlike gold or silver, there's obviously some danger, right, with storing, uranium.
No danger at all.
Okay.
I mean, basically what we store is something called U3O8, uranium oxide, and it basically looks like a yellow powder, and it's stored in a steel drum just outside on a concrete pad, and stack the barrels up.
Joel, no smoking. You can't light a cigarette in there. Right? Is that a rule?
I hope there's no smoking anyway.
Okay.
But it's a fairly inert substance. And yeah, we have over 75 million pounds of the stuff that we store in the United States, Canada, and France. And it's obviously a very early stage product. It has to get refined into enriched uranium, which obviously then goes into a reactor core. But yeah, our investors have been huge supporters of the vehicle, and it has grown enormously since we launched it almost 5 years ago.
Actually, I'll bring this back as a way of asking you to answer a question that I teased, but that we didn't ask. You have the physical back stuff, and we've spent some time talking about that. The portfolio also includes a lot of miners. When do you, what's the purpose of the miners, and when does that trade take off versus the physical back stuff? And this goes for across the portfolio, right? You've copper miners, uranium miners, gold and silver miners? Like, what's the relationship between the physical backed stuff and the miners?
Yeah, great question. I mean, we try to offer our clients both, where we can, options in physical metals, and we do that in about 6 different metals. And then obviously the related mining companies, and they both have different attributes. The physical commodities, you're playing the spot market. You're playing a bullish view that the price of copper is going to continue to go up. And copper recently hit an all-time high, like it has for silver, gold, and platinum. The miners are obviously tied heavily to the commodity price, but they obviously have enormous operating leverage. And they also have a lot of optionality with the discoveries and bringing new discoveries into production. So they're more volatile, but they can obviously create tremendous value for investors when they are benefiting from higher commodity prices, but also when they're bringing new production to market. And right now, a lot of these mining companies are minting profits because the commodity prices are high and they are finally getting capital to move their projects forward. There was a long period of time where nobody wanted to invest in this segment. Everybody was invested in having a good time in tech stocks. And we're seeing a rotation going on right now where capital's finally, in the last, I would say, 12 to 18 months, coming back into these sectors, which is allowing many of these companies to move their projects forward, which is how they ultimately create value for investors. So we find most investors will invest in some ratio between the two. Sometimes it's driven by relative value. Sometimes it's risk tolerance. So a lot of our institutional investors, they like to own the physical commodities sprinkled with some of the hot sauce, as Eric likes to call it. So we don't have a prescribed formula, but we find most of our investors hold these things in tandem.
Okay.
And is there any commodity, just, last question, that people are forgetting about? Like, we just went over some of the big ones. Like, you have a nickel ETF. Like, is there anything like...
But everything's up, right? Eric's right. Is there anything that we haven't thought
well,
about? Or what else are you thinking about?
What's the dark horse commodity right now?
Ooh, the dark horse commodity. That's a good question. They've all been moving together, which is very odd. Commodities typically all have their own little cycles. Dark horse commodity. Maybe lithium. Lithium kind of came back to life last year after getting really washed out after a period of excessive pricing. But lithium has kind of come back to life. Nickel is stabilized. There was a period there where Indonesia was kind of flooding the market with nickel. That seems to be being put in check a little bit as they've realized they've disturbed the market. But the other one that we're excited about is copper. Copper's finally starting to hit new highs. And what you find when these metals finally break new highs, it provides kind of a psychological signal to investors. And the copper miners have done incredibly well the last couple of years. They're really printing money right now. And copper is so important for so many different industries that and so much of it is around electrification right now. So copper is another one we're pretty excited about.
Okay, John, final question. It's a personal one. I'm curious, is your personal portfolio, does it have anything other than metals in it? Or like, do you own stocks and bonds, or is it just metals?
Oh, absolutely.
No. But gold miners don't count. No. I'm talking like regular stocks.
Oh, absolutely. I invest in all kinds of tech stocks, and yeah, absolutely. I mean, I have a lot of economic exposure to these metals through my work income, so I have a great hedge there. But yeah, absolutely. I mean, I am a proponent of having a diversified portfolio.
Okay, I'm going to ask a follow-up question. That's also one that we ask a lot in Trillions. I got to say, Goldbug, G-Bug, great ticker.
Yeah.
That's a world-class ticker. Is there any ticker that you think is better than that one?
That's a really great ticker. And when I found out it was available, I said, let's grab it right away.
I bet you did, yeah.
He may like glitter, GLTR. Ooh. That's the Aberdeen Physical Precious Metals Basket, which is gold, silver, platinum, palladium. That's pretty good, right?
Any other ticker envy, John?
I was a little disappointed, to be honest with you, when the ticker gold just got reassigned to somebody after Barrick Mining dropped it, which was
who got it?
A puzzling thing. A company involved, I can't remember the name of it, but a company involved
probably
in
Matt Tuttle.
Kind of coal, kind of precious metals and coins and stuff.
Okay.
but that's a killer ticker too.
Okay. All right, John, thanks so much for joining us on Trillions again.
Thanks so much. It was great to be back.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen.